Guys, in the world of multifamily real estate, people starting out tend to focus on locating the deal or even raising the money. And while these things are important, one important item that's often overlooked is the financing. The wrong financing can kill a deal or it can make the deal. To me, it's just as important as raising the equity to get the deal closed. Commercial loans are different from residential loans that are 4 units or less. Unlike residential loans, commercial loans have many different programs and many different options. On the residential side, you're looking at the rate and term. While both are important, these two are the most familiar that people not active in real estate understand. However, when you're looking at a deal that's specifically around a multi-million dollar commercial loan, there are many ways to finance a deal that impact your overall cash flow. So understanding the different parts of a loan program and how they can affect your returns is super important. So here are my 5 parts that you need to know to maximize your returns. Number one, interest rate. The interest rate is the amount charged by the lender. It's expressed as a percentage of the principal to the borrower. So interest rates are typically charged on an annual basis. And number two, the loan to value. So the loan to value is a ratio. It's the amount of the loan compared to the value of the property. So this ratio is calculated by the lender prior to providing the loan. So if the property is valued at $1 million and the bank would give you $750,000, you have an LTV of 75%. So this percentage will be dependent on the strength of the property and the strength of the borrower. Typically, banks will have an LTV of about 65 to 80%. These two things, the interest rate and the LTV, are the parts that most people focus on. It gives you an idea as to what the cost of the borrowing is going to be and what the cost of the money is going to be. Not only that, how much they're going to lend to you and how much you need to bring to the table as well. However, there's other parts that are just as important, so let's continue. 3, the terms. Now, the terms of the loan can sometimes be flexible depending on the loan product. The loan is the period until the loan becomes due and payable. So a typical loan will have like a 5-year term and a 25-year amortization schedule, basically, is what it is. Your payment will contain a portion of the principal plus interest over this 5 years, and the payment amount will be based on a 25-year schedule. The longer the amortization period, that typically means smaller payments. The loan terms you will want is dependent on your business plan. If you plan on holding the deal for a long period of time, it'll make sense to get a low rate, 25 or 30-year amortization as well. So if your business plan though calls for like to do a value add to a property and you're going to refinance over a short period of time, a 24 month, interest only bridge loan may be the best option. After you add value, they can refinance and pull your money out of it or get into some long-term debt. Number 3, recourse or non-recourse. When it comes to residential loans, banks want someone that they can go after if the loan isn't paid. They want someone to take responsibility and have some sort of personal guarantee on a loan. But when it comes to commercial, it's different. Depending on the terms of the deal, you may either have a non-recourse or a recourse loan. If you have a non-recourse loan and a loan goes bad, the lender all they could do is basically come after you for your equity part, which may still be substantial. Additionally, you're personally protected if you didn't neglect the property or do some sort of fraud against the lender as well. So, if there are many options when it comes to multifamily buyers that do not have the recourse. If you keep the LTV about 65 to 75% and the loan is large enough, you can stay non-recourse. In either case, if the loan goes bad, the chances of you getting another loan and raising the capital you need to take down a deal is drastically reduced. So it's important that you make solid, good deals and work deals that make sense. Don't overpay for a deal because you think the financing is cheap or the money is available. Never do that. That could really bite you. Number 5, prepayment penalty. As the name implies, if you want to pay the loan off before some sort of set term, it's usually the case when you're doing a refi, the lender will charge you a fee. This is typically like a step down percentage depending on the term, so it could vary. For example, let's say you have a 3-year term, you'd be charged 3% in year 1, 2% in year 2, and 1% in year 3 if you paid in any one of those periods before the term is up. So again, if your plan is to reposition the property after 24 months and you're getting into a 3-year term, you're going to have a prepayment penalty. So it's probably not a good idea to do that. But if you tell the lender up front what the business plan is, they should be able to come up with a solution. So anyway, that's it. As I touched on in the final section, you need to align the goal of your project with the right financing. If the goal is to hold a property long term, then don't get a 3-year loan with 2 extensions. If your goal is to buy and reposition a property after 18 months, don't get into a long-term product with a prepayment penalty. Every deal must be approached differently, and the goal of your investors, your strategy, and the lender must line up in order for it to be successful. So anyway, what do you think? Do you have any additional considerations that I didn't touch on here? Please leave a comment and let me know. Hope you're having a good day, and talk to you again soon.